Second quarter GDP data came out this week, and it seems that we are in a second quarter of consecutive contraction. Real GDP contracted by 0.9%. And now the question is what to do. Well, Peter Berezin, Chief Global Strategist of BCA Research, joins us today to discuss a possible recession, economic downturn, Fed policy, and how investors should be positioned now in light of recent data. Welcome back to the show, Peter.
Good to be back.
Let's address some concerns. There seems to be some confusion regarding the definition of a recession. This is not coming from the average layman. This is coming from government officials who seem to be in disagreement over what a recession actually is. Now, Brian Deese, for example, National Economic Council Director of the Biden administration, has recently, on an appearance with other media, denied that a recession is 2 consecutive quarters of GDP growth. He has in the past said that this is the case, but now I think he's flip-flopped. Biden himself has questioned whether or not we are in a recession. Earlier in the week, he has told reporters that he doesn't think we are, and he cited the strong labor market as a reason as to why the economy is still doing strong. So let me just start by asking you, Peter, what is a recession?
Well, a recession in the U.S. is anything that the National Bureau of Economic Research deems to be a recession. So this is a group that is comprised of a number of academics from both sides of the political aisle. They're generally nonpartisan. I don't think that they would try to define a recession in a way that favors one party or another. The reality right now is that some measures of economic activity are pointing to a recession, others are not. And in particular, the labor market, which often weakens during recession, has not yet begun to weaken. There has never been a recession in U.S. history where the unemployment rate has not risen. Well, so far it hasn't risen. So I think right now it is fair to say that we're not in a recession, but we are getting awfully close to one.
How long does it usually take for NBER to come up with a decision?
This could last, the process could last well over a year. So you wouldn't expect a verdict in real time. And that's partly because the data gets revised. Like we estimate based on our calculations, there's actually a 35% chance that Q2 real GDP growth will eventually be revised into positive territory. In fact, if you look at Q1 growth, which was also negative, while other measures of economic activity, such as gross domestic income, which conceptually should equal gross domestic product, gross domestic income actually rose by 1.8% in Q1. So it's possible that GDP for Q1 will also be revised to show positive growth. So right now, I think it's too early to say, given that the data has not yet been finalized. But it is true, and I think this is the bigger point, that the economy is slowing, and that's something that the Fed wants to achieve.
Well, we had a very short recession in 2020. I think NBER designated it that period as a very short recession. Is it not possible that we could have the same thing? Suppose third quarter GDP revises upwards and bounces back into positive territory. Could you not still argue that we had a recession this year, albeit for just 2 quarters?
I would be surprised if the NBER were to deem this period a recession unless the unemployment rate starts rising. And what could be surprising this time around is that it takes a while for the unemployment rate to rise, because right now you've got these large number of job openings. There's about 1.9 job openings for every unemployed worker. So even those firms that start laying off workers, the people who lose their jobs in many cases are just going to be able to go right across the street and find a new job. So I don't think we're going to see an increase in the unemployment rate probably this year, in which case it may be the case that the recession doesn't start this year, it could start next year or the year after. But right now I think it's premature to make a call that we're in a recession.
All right. Well, I'll just show you a few of Chair Powell's remarks from earlier this week after the FOMC meeting. This is one of them.
And the reason is there are just too many areas of the economy that are performing, too well. And of course, I would point to the labor market in particular. As I mentioned, it's true that growth is slowing, and for reasons that we understand. Really, the growth was extraordinarily high last year, 5.5%. We would have expected growth to slow. There's also more slowing going on now. But if you look at the labor market, you've got growth. I think payroll jobs averaging 450,000 per month. That's a remarkably strong level for this state of affairs.
So is he right that there are too many areas of the economy that are performing too well, Peter?
I think he is right. And in particular, if you look at consumers, they're still spending despite the fact that real wages are shrinking. Now, it's quite possible, and in fact, quite likely, that inflation will come down over the next 12 months. Maybe it doesn't go from 9 to 2%, but it probably will go from 9 to at least 4%. If that were to happen, then real wages, rather than shrinking, are going to start rising. That will boost consumer confidence. And if consumer confidence rises, you're going to get even more consumption, which again kind of makes a recession in the near term somewhat unlikely.
Okay, interesting. And how likely do you think that we could enter a period of rapid growth by the end of the year that would force the Federal Reserve to pivot back into quantitative easing?
Well, I don't think we're going to have rapid growth anytime soon because the unemployment rate is very low. And so the supply side of the economy is constrained by increases in labor supply and productivity growth, neither of which are going to increase very much. So I think probably what's going to happen is that the economy will sort of putter around for 12 months or so. Inflation will fall, things will look good. I think the stock market will probably rise over the next 6 months. But then I think as we get into next year, it'll become pretty clear that the economy is just too healthy to require rate cuts, which is what the market currently is pricing in. And that actually could be a headwind for equities.
Yes, I misspoke. Let me clarify. I meant pivot into quantitative tightening. They're already, quantitative tightening. How likely is it that they will, by the end of the year, some people have told me that they're possibly going to pivot and not only stop rate hikes, but just reverse course and cut rates all the way back down to zero again?
I think that's really unlikely. And the reason I think it's really unlikely is because inflation, one, is too high. And even if inflation does fall to 4 is not the target for the Fed, 2% is the target. And second of all, I think the Fed and the market, for that matter, is underestimating the neutral rate of interest. I think the US needs interest rates of around 3 or 4%. The market thinks the Fed is going to bring rates to around 3.5 and then drop them down to 2.5. That would be only true if the equilibrium rate of interest were really low. I don't think it is. And in fact, the evidence over the last couple of years suggests that it is quite high, because if the equilibrium rate really were so low, we probably wouldn't have an overheated economy now.
Well, let's talk about Fed policy. First of all, is it common for a Federal Reserve for the Federal Reserve to raise rates during an economic slowdown? Whether or not we are in a technical recession is, I guess, up for debate. But when the economy is slowing down, is that customary policy to raise rates?
Not in the recent past, but the Fed certainly did do that in the 1970s and early 80s. So again, a lot depends on how quickly inflation falls. Certainly, some of the supply side bottlenecks that have lifted inflation will dissipate over time, and that will help reduce inflation. Will inflation fall all the way to 2 without any increase in the unemployment rate? That's less certain. So I'm not saying that we're going to avoid a recession. I think we'll avoid one for the next 12 months, but ultimately it might take some economic pain to finally bring inflation back down to 2%.
What is the Fed's objective right now? Are they trying to engineer a recession? Are they trying to engineer some sort of landing, hard or soft?
Well, I think the Fed's primary goal is to bring down inflation to its statutory target of 2%. Now, of course, the Fed doesn't want to induce a recession in doing this, but if that's the price that has to be paid, that's the price that the Fed will pay. In practice, it is difficult to engineer soft landings. In fact, there hasn't been a case ever in the United States where the unemployment rate has risen by more than 1/3 of a percentage point without a recession ensuing. So the Fed's hope of just lifting unemployment by 0.5%, that might prove to be difficult to pull off.
The current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by 0.75 percentage point, and anticipates that ongoing increases in the target range for the federal funds rate will be appropriate.
He also said that another unusually large increase could be appropriate at the September meeting. So he's hinting at not only more rate hikes, but potentially a larger magnitude rate hike. Is this something that's in the cards, Peter? Do you think they'll actually go through with another 75 basis point or perhaps even 1% increase by the next meeting?
I don't think so. I think they're probably going to do 50 basis points and then maybe do 25 basis points and then just wait and see how the economy responds. Because as the old economic adage goes, monetary policy operates with long and variable lags, typically 12 to 18 months. The Fed wants to see what the effect of this tightening is before they continue.
There is a view out there from some economists that in order to bring down inflation, the Federal Reserve needs to raise the Fed funds rate above the rate of inflation itself. So currently that's 9.1%. Is that a view that you share?
Well, it kind of depends on what inflation measure you focus on. So core inflation is around 5, headline is around 9. Inflation expectations are actually quite low. So what is it that you're really trying to target? I think it's certainly true that the Fed needs to keep real interest rates in positive territory, at least as measured by inflation expectations. And that probably means having to lift the Fed funds rate to around 3.5%. It might require ultimately for the Fed funds rate to go higher than that to bring inflation to 2%.
So we don't need a Volcker-esque type of raise where it goes to, back then it was 19% Fed funds rate. The inflation rate was at double digits. We don't need the rates to go to 10% right now.
We don't need anything so dramatic because long-term inflation expectations, unlike what was the case in the late 70s and early 80s, are very well anchored. If you look at the University of Michigan survey, there's a question that asks households where they expect inflation to be 5 to 10 years out. The latest number is 2.8%. That's basically where it was between the late 1990s and 2015. If you look at market-based inflation expectations, such as the 5-year forward TIPS break-even inflation rate, the market's estimate of where inflation will be in 5 years, if anything, that's below the Fed's target. So you don't need anything as dramatic as what we saw in 1982.
You brought up inflation expectations being low. That's a great point. I'd like to ask you this, right? The TIPS, for example, the Treasury Inflation Protection Security, which is one measure of inflation expectations, that's been trending down all year. Why is there a discrepancy? Why has that been going down while CPI has been trickling up?
Well, because the Fed has gotten more aggressive in raising rates rather than dragging its feet. The Fed has said, bring down inflation is its top objective. And so the market takes the Fed seriously. The market knows now that the Fed is prepared to allow the economy to weaken, perhaps even slip into recession in order to bring down inflation to its target. And that's why these long-term inflation expectations have declined.
Do you think the markets have priced in peak inflation already? We've seen commodities decline. Lumber, steel, copper, for example, have all fallen. The food index from the United Nations, from the Food and the Food Organization of the United Nations has put out an index of their basket of agricultural commodities. That's been declining 3 months in a row. I wonder what this means. Is it the end for inflation? Is it coming down? Is it the peak, or is it going to go back higher, you think?
Well, the market certainly thinks it is the peak. If you look at those TIPS, they're pricing in a fairly rapid decline in inflation. I think inflation will come down. Certainly a number of commodity prices, as you mentioned, from various agricultural goods to lumber to metal prices have rolled over. Oil, not so much, so that's still hanging in there. But other measures that are pertinent to inflation, such as auto prices, they seem to be coming down now. So inflation will fall. The question is not whether inflation will fall. The question is whether it will fall to 2%. That might require some economic suffering, unfortunately.
All right, well, final question on inflation. We'll move on to investments. So yeah, 2%. Powell did say over the coming months, we'll be looking for compelling evidence that inflation will be moving to 2%. He didn't say it's going to be at 2%. It's going to move towards 2%. When can we see inflation back down in the 2 to 3% range, which is what we've seen over the last decade or so?
Well, the Fed expects inflation to fall to around 4% by the end of this year and then trend towards 2 to 3% in 2023. So that's kind of the Fed's timeline. So we don't need 2% inflation within the next 5 to 6 months. That's too ambitious. But what we do need to see is clear evidence that inflation is declining. And we also need to see clear evidence that those inflation expectations that we just discussed remain well anchored around the Fed's 2% target.
So putting all this together, then, how would you describe the current macroeconomic landscape and your forecast for the coming quarters? Would you characterize this situation as one of stagflation anymore?
I wouldn't characterize it as stagflation, because a stagflationary environment is one where inflation is rising and unemployment is high. Right now, I think we're going to see inflation decline, and unemployment, rather than being high, is in fact very, very low. So we're not in a stagflationary environment, but we are in a rather worrisome environment in the sense that inflation is well above the Fed's target. And that means that monetary policy will probably end up having to be tighter than what most investors expect.
Okay, so given this worrisome economic environment that we're in your words, what should investors do?
So we just moved to neutral in our equity allocation recommendation. I think over the next 6 months, markets probably still manage to go up as recession risks fade. But then as we get into early next year, what we're going to see is the markets start to weaken again as it becomes obvious the Fed does not have any reason to cut rates, and in fact may actually need to raise rates further in order to bring inflation back down to that 2% objective.
I want to talk about some recession-proof assets, if ever there is such a thing. Certainly there have been assets that have performed better than others in past recessions. For example, discount retailers, consumer staples. Walmart, for example, in 2008, between 2008 and 2009, went up 20%. That's just one example. Suppose we are in a recession, Peter, just suppose. Are there specific sectors that you think will outperform this time around?
Well, some of these consumer staples, they've come down quite a bit. They might be worth owning if you think that we're heading into a recession imminently. Certainly, there are other defensive sectors such as healthcare that I think should do reasonably well. But the reality is that when recessions occur, stocks usually go down. So often there aren't that many places to hide. And in particular, this time around, if the reason we have a recession is because inflation is too high, then hiding in bonds may not be such a great idea either.
Generally speaking, though, Peter, are there businesses that tend to do better during a recession?
Sure, businesses that sell things that people have to buy. So consumer staples, necessities, healthcare, as I mentioned. What you want to avoid is the discretionary stuff. If people can forego buying a refrigerator, they'll do that during a recession. It's not too easy to forego buying food.
Are there any safe haven assets that you would consider? Would the dollar be considered a safe haven? Treasuries, gold?
The dollar is a safe haven currency. So if we have a recession, then the dollar probably would strengthen. The only caveat is the dollar has gotten very, very expensive. So relative to its purchasing power parity exchange rate, so that's the exchange rate that equalizes the price of a basket of goods and services across countries. The dollar is about as overvalued now as it was in 2000 when it peaked, and almost as overvalued as it was in 1985 when the Plaza Accord was signed. So the dollar could strengthen, but valuations suggest that over the long term, the dollar will probably weaken.
Okay, over the long term, the dollar will probably. Are you assuming then that other central banks won't be as hawkish as the Fed?
I think probably that's true. I think that the ECB does not have the need to raise rates in the way that the Fed has, simply because the economy there is weaker. I think almost certainly the euro area economy will be in recession in the second half of this year. And in the case of Japan, there you have an economy that has entrenched deflationary expectations. So there's really no need for the BOJ to raise rates anytime soon.
I'd like you to address some of the alternative assets. I'm not talking about cryptos. I'm talking about stuff like artwork, guns. Someone submitted this to me. Whiskey might be an alternative asset. Farmland. Anything that's not in your typical S&P 500, I guess.
I don't know if up in Canada we can buy guns as a maybe as a safe haven
Fair
asset in
enough.
some sense, but not one that you can legally own. So I think you just have to be a little bit careful. If you think that stagflation is around the corner, it's not my view, but if that's your view, then the template of the 70s is pertinent. And which asset class did best in the 70s? Farmland. So that's something that you want to consider. What else did
Yes.
well in the 70s? Gold, right? So that's another classic inflation hedge.
Farmland's an interesting one because agriculture commodities, actually in real terms, I was looking at data from the UN, in real terms, food has not been this expensive since the early 60s, since that chart, the chart only goes back to the early 60s, but since the early 60s, food has never been this expensive. It is starting to trend down a little bit, but I wonder what this means for farmland right now.
Sure. So farmland is real asset in an inflationary environment. That's something you want to consider. Now, agricultural prices, as we mentioned earlier, have declined. In fact,
Yes.
not that long ago, there was this worry that wheat prices would go so high that we would see famines in parts of North Africa and the Middle East. But in fact, wheat prices have basically fallen back to where they were prior to Russia's invasion of Ukraine. So again, you have to be a little bit nimble here. We are living in a world that has the capacity to produce a lot of things, including food. It's not a Malthusian world anymore. So while agricultural prices could rise, I would be skeptical that they would stay high for a very long period of time.
Finally, are there any geopolitical risks on the horizon that you think could throw everything off kilter again?
Well, I mean, almost by their very nature, it's hard to predict these
Yes.
risks. But certainly, we don't know what's going to happen in Ukraine. It might be the case that Putin is content to just carve off parts of eastern Ukraine, declare victory, and try to move on. Of course, also seeing rumblings around Taiwan. These are definite risks. We've also seen a number of emerging markets. Sri Lanka move towards defaulting. Pakistan is probably close to also defaulting. So we're going to see political turbulence. We're going to see economic turbulence. So right now, I think kind of a neutral weighting towards equities is appropriate.
Great. All right. Well, Peter, I appreciate your thoughts. Thank you very much for your time today.
My pleasure. Thank you very much, David.
Thank you for watching Kitco News. I'm David Lin.